After 4 episodes of pure number crunching, I finally ran the exact comparison you've been asking for. I took the same 3 properties from my short-term rentals and put them through a brutal math test for 2026. The results genuinely shocked me, and they'll completely change how you compare real estate returns. I stacked Airbnb math against 2 very different replacement models. The winner's cruel to anyone chasing dashboard hype instead of raw math. When I first looked at my top-line Airbnb revenue, I was convinced I'm crushing it. But the moment I actually sat down and subtracted every hidden cost, cleaning fees, platform cuts, wear and tear, the picture flipped completely. I'd spent 2 years measuring the wrong number. That's the exact ledger I'm handing you today, using my real corporate bank deposits, not theoretical numbers. Today we're running 3 models side by side using my actual 3 properties: a traditional long-term lease, a mid-term corporate housing setup, and a commercial syndication play. Same 3 properties, 3 completely different financial outcomes. By the end, you'll know exactly which lever fits your own timeline, your own risk tolerance, and how many hours a month you're actually willing to work. Let's start with Model A, the traditional 12-month residential lease. At the peak of my Airbnb business, my 3 properties generated a combined gross of $13,500 a month. That looked incredible on a dashboard, but operating costs regularly ate up 60% of that number. And most hosts never sit down and actually calculate what's left over. Once I underwrote those same 3 properties as standard 12-month leases, the open market rent came in at $2,200 per property per month. That's an aggregate gross income of $6,600 a month. With a long-term tenant, the math gets simple. They cover their own utilities, internet, and minor maintenance. My only fixed costs are the mortgage, property taxes, insurance, and a 10% reserve for capital repairs. Those fixed costs land at $1,600 per property. Per month, $4,800 total. Subtract that from the $6,600 gross, and you're left with $1,800 a month in net cash flow across the whole portfolio. That's $600 per door. The management workload here is under 2 hours a month across all 3 properties. It's stable, it's locked in by contract, and it protects your downside completely. But if you're trying to replace a full-time income, $1,800 a month is a brutal number to look at. Model A's the right call if capital preservation matters more to you than maximizing yield. If you want a tenant who signs a standard lease and disappears into the background, if your goal is simply to hold real estate without drama, $1,800 a month with almost 0 time invested is a completely legitimate outcome. It's just not the ceiling. Model A gives you a predictable floor, but what if you need real cash flow without turning your properties into a second full-time job? That's where Model B comes in. Model B is medium-term corporate and relocation housing, 30-day to 6-month furnished leases for corporate executives, insurance relocations, and traveling medical professionals. Because of who you're serving, you can charge a real premium over standard market rent. I ran the actual comparable data for my 3 properties. They underwrite at an average corporate lease rate of $3,500 per property per month. That's $10,500 in aggregate gross income across the 3 assets. But corporate renters expect more than a bare unit. You're covering high-speed internet, premium utilities, meticulous landscaping, and a rolling reserve for furniture replacement. Those extras add up fast. Utilities run $350. Cleaning resets between placements run $250. Corporate platform placement fees run 5%. Add the baseline mortgage, tax, and insurance of $1,600, and your total expense per property climbs to $2,375 a month. Across 3 properties, that's $7,125 in monthly expenses. Subtract that from the $10,500 gross, and Model B nets you $3,375 a month, $1,125 per door. That's nearly double Model A. The catch is the workload. You're looking at roughly 12 hours a month coordinating placements and managing corporate accounts. You keep most of the premium yield, but you're still tied to an active management wheel between placements, and there's real vacancy risk if a corporate contract ends earlier than planned. To protect against that vacancy gap, I keep every property listed simultaneously across 2 or 3 corporate placement networks instead of just 1. That way, when one contract ends, the next placement is already lined up instead of leaving the unit sitting empty for weeks. The best Model B tenants are companies with predictable relocation cycles, hospital systems rotating traveling nurses, insurance carriers displacing policyholders, and corporations relocating new hires. Once you land 2 or 3 of these accounts, your placement pipeline becomes far more predictable than any individual short-term guest ever was. Model B's the right call if you're still early in building your portfolio and you need every available dollar of cash flow to reinvest or cover your own bills. 12 hours a month is real work, but it's nowhere close to a full-time job, and $1,125 per door is a meaningful jump over the traditional lease. On average, my corporate placements run 4 to 5 months before turnover, compared to guests who stayed 2 or 3 nights on Airbnb. Fewer turnovers means fewer gaps, fewer cleaning cycles, and far less day-to-day noise, even though the model still requires real oversight. So what if your goal is to completely sever the tie between your time and your cash flow? That's where Model C comes in, and it's the one that trips up most residential investors. Model C means liquidating your residential properties entirely and reallocating that equity into a commercial triple net syndication. You give up direct ownership of the physical asset. In exchange, your capital sits inside a diversified portfolio of credit tenant commercial properties, and distributions are calculated on a straight net cash-on-cash basis. There's a real tax cost to this move. Liquidating triggers capital gains, and depending on your basis, that can mean a real check to the IRS before your money ever reaches the syndication. Run that number before you commit, because it changes your actual starting capital. One more thing to weigh with Model C: your capital's far less liquid once it's inside a syndication. Most funds lock your investment for 3 to 7 years before you can exit without a penalty. If you think you might need that capital back quickly, that illiquidity matters just as much as the yield. Picture the actual transaction. You sell the properties, pay off the remaining debt, and wire what's left into a commercial fund. From that point forward, you're a passive investor, not a landlord. Here's the real math on my situation. My equity across the 3 original properties came out to $450,000 in liquid capital after paying off debt and covering the tax bill. I deployed that entire amount into a syndication paying a stable 8% net cash-on-cash annual return. That's $36,000 a year in distributions, exactly $3,000 a month. And the workload? Zero. The commercial tenants cover their own taxes, structural maintenance, insurance, and daily operations. You do not get a single property management call. You've traded the volatility of residential tenants for a completely hands-free income stream, but you've also traded away the property itself. Model C's the right call if your priority has shifted from growing your portfolio to protecting the wealth you already built. You give up appreciation on the physical asset, and you give up control over which tenant occupies the building. In exchange, you get a completely predictable check every month with 0 phone calls. You do not have to pick just one model for your whole portfolio either. Plenty of investors run one property as Model A for stability, one as Model B for yield, and gradually shift capital into Model C as they get closer to retirement. Mixing models across a portfolio is often smarter than betting everything on one. Model C hands you a completely hands-free $3,000 a month. But before you make the call to liquidate your whole portfolio, you need to see all 3 side by side. Here's the full scorecard. Model A, $1,800 a month, under 2 hours of work, maximum security, minimum upside. Model B, $3,375 a month, 12 hours of work, the highest top-line cash flow of the 3. Model C, $3,000 a month, 0 hours of work, but you no longer own the physical asset. Look at that layout for a second. Model B wins on raw cash flow. None of these is universally correct. The right answer depends entirely on whether you're optimizing for income, time, or ownership. Model C nearly matches it with 0 labor. The math proves one thing clearly: staying stuck inside an unpredictable short-term rental setup's a mistake against where the market's heading in 2026. Model A gives you the least cash but the most control. You do not have to accept constant operational stress as the cost of building real estate wealth. Run these actual numbers against your own properties, and you'll know exactly which lever to pull. I made all 3 of these mistakes myself before I ever ran a real spreadsheet. chasing the biggest gross number instead of the actual number that landed in my account after every expense and every hour of my own time. Do not repeat that mistake. The property that looks the most impressive on paper's not always the one that actually builds your life. Pull your own numbers this week. Look at your gross rent, subtract every real expense, not the ones you assume, and calculate your actual dollars per hour of work. That single number will tell you which model fits your life, not just your spreadsheet. If you want to see the real numbers behind every model I test on this channel, hit that subscribe button right now. We run the actual math here every single week. Now you've seen the math on paper for all 3 models. But which one did I actually choose to execute? In our very next episode, I'm pulling back the curtain completely, the exact model I picked, and every step I took to set it up from scratch, including what turned out to be way easier than expected, and the traps that were brutally harder. The full model reveal and setup blueprints waiting for you in episode 5 right now. The playlist is live. Do not stand still. Click the next video, and let's build this together.